If I'm going to talk about Robo Advisors, I need to start by clearing something up. These firms do not employ robots. They do not use artificial intelligence or machine learning to build your portfolio or to give you advice. Robo Advisors are simply pared down wealth management firms that allow you to easily open an investment account and choose an appropriate portfolio online without speaking to a human. While they may not be employing super intelligent robots, these firms are using technology extremely well to reduce the amount of human contact that their customers need. Leveraging technology to reduce the need for humans allows robo-advisors to keep their fees low compared to traditional mutual funds and fee-based financial advice firms. So far, this sounds pretty good. Ease of use and low fees due to great technology. And it is pretty good, but as always, it is important to look past the flashy marketing and consider some important factors. I'm Ben Felix, Associate Portfolio Manager at PWL Capital. In this episode of Common Sense Investing, I'm going to tell you about Robo Advisors. Canadian investors are starting to understand that high fees and commission mutual fund salespeople are not good for their financial health. Investors seeking low-cost index fund portfolios have an increasing amount of choice in Canada. Through the Canadian Couch Potato blog, my PWL Capital colleague Dan Bortolotti popularized the idea that you could manage your own investments using ETFs or index mutual funds. For investors with more complicated situations, there are full-service wealth management firms using low-cost index funds, like PWL Capital. Robo-advisors fall somewhere in between these two options. Many people do value a relationship with a professional wealth manager. This may be due to the complexity of their situation, the magnitude of their assets, or their general level of comfort with financial markets. In any case, those people tend to be comfortable paying the fee associated with a full-service wealth management firm. Despite their lower fees, I do not believe that robo-advisors are an attractive alternative for these people. For anyone with a simple situation, the choice between the DIY route and using a robo-advisor takes some consideration. We are really weighing the cost against value of the fee that robo-advisors charge. So let's think about exactly what value they are providing. There are a lot of different robo-advisors in Canada with slightly different fees and service offerings. So to keep things simple for this video, I'm going to use wealthsimple as my example. They are the largest and probably best known robo-advisor in Canada. They charge 0.5% of invested assets on the first $99,999 and 0.4% of assets over $100,000. Before I continue, I do want to clarify that I am in no way affiliated with Wealthsimple. Wealthsimple implements and rebalances your portfolio for you. This is one of the biggest hurdles for many investors. As simple as buying ETFs or index mutual funds can be, Wealthsimple makes it even easier. Keep in mind that waiting for a year or more to start your DIY portfolio because you got busy is likely to cost you, on average, far more than Wealthsimple's fee. If you can't take action yourself, then there is definitely value in the ease of use that Wealthsimple has created. I believe that a good amount of this value was eroded when Vanguard recently came out with their One Fund Solution ETFs in Canada. Buying a single self-rebalancing ETF is potentially less intimidating than needing to buy 3 or more ETFs to build a well-diversified portfolio. To make it even easier, my PWL Capital colleague Justin Bender has made YouTube videos that walk you through the steps of purchasing an ETF. Wealthsimple tracks your adjusted cost base in your taxable accounts. This is a somewhat tedious task that DIY investors have to deal with. My PWL colleague Justin Bender has written a guide on how DIY investors can track their adjusted cost base. It is not rocket science, but it is a thing that DIY ETF investors have to do. If you only have RRSP and TFSA accounts, then there's no value here. If you have taxable accounts, then yeah, there's some value. Wealthsimple harvests your tax losses. This is only available to Wealthsimple Black customers who are required to have over $100,000 invested. Tax loss harvesting is maybe a good thing for people in certain situations. It only matters if you have a taxable investment account. Maybe there's some value here, depending on your situation, but a DIY investor could easily harvest their own tax losses. Wealthsimple Black customers do also get a complimentary Priority Pass membership, which lets you into airport lounges. That's kind of neat, I guess, but it's also kind of a gimmick. I don't see any real value there. Wealthsimple invests your monthly contributions for you. This is very convenient. ETFs have to be purchased like a stock, making it a bit of a hassle for a DIY ETF investor to set up a regular monthly contribution. They would have to log into their brokerage account monthly to buy more ETF units. There is definitely a bit of value here, but if this was the main reason to choose Wealthsimple, then something like the TDE series mutual funds are a slightly less expensive alternative that offers the same convenience. Finally, the one thing that Wealthsimple provides that I believe could be truly valuable is access to financial advice. Basic advice is available to all customers. You can speak to a Wealthsimple advisor by phone or by email. As far as I can tell, they are fairly accessible and responsive. You do not get a relationship with one dedicated advisor. Wealthsimple Black customers get access to financial planning sessions. Great. Advice is accessible by phone and email. Of course, the question that follows is, what is the quality of the advice? I am in no position to comment on the quality of advice that Wealthsimple provides. I have no direct experience with them as a customer. What I do know is that they announced in March 2018 that they had reached 65,000 customers. And as of June 25, 2018, the Canadian Securities Administrators National Registration Search shows that there are 10 people employed by Wealthsimple who are licensed to give investment advice. That is over 6,500 clients per licensed advisor. If their advisors worked 40 hours per week and took no vacations, they could spend about 19 minutes thinking about each customer if they spent all of their time thinking about their customers. This is not necessarily a bad thing. It's a byproduct of their low-cost business model. But it should be considered when comparing Wealthsimple to a DIY approach. As valuable as investment advice is, I would not choose Wealthsimple for the advice alone. Speaking of financial advice, one thing that I have noticed in talking to Wealthsimple customers is that Wealthsimple's automated portfolio recommendations tend to be on the conservative side. Wealthsimple customers who know little about investing are answering a handful of questions and being placed into a portfolio by a computer program. It makes sense that the program would tend to be more conservative than aggressive to protect both the customer and Wealthsimple. I'm not saying that everyone should invest in a 100% equity portfolio. But in my experience, a simple conversation about risk often leads to a higher risk tolerance. Asset allocation is one of the most important drivers of returns. If Robo Advisors algorithms tend to place investors in more conservative portfolios, there could be a substantial implicit cost to their customers. I don't want to come across as being negative toward Robo Advisors in general, or Wealthsimple specifically. I think that robo-advisors are an excellent alternative to expensive, actively managed mutual funds, but it is important to weigh the costs against the DIY approach. Regarding Wealthsimple, I would not say that they are providing so much value for their fee that it is obvious that everyone should invest with them. But I think that they are a great option for people with simple situations who do not need in-depth advice, want to be completely hands-off, and don't mind paying a fee. On the other hand, with great resources online like the Canadian Couch Potato blog and Justin Bender's DIY investing YouTube videos, I do not think that DIY investing is out of reach for anyone. This is especially true since Vanguard's new all-in-one ETF portfolios came on the market. What do you think? Wealthsimple or DIY? Tell me why in the comments. Thanks for watching. My name is Ben Felix of PWL Capital, and this is Common Sense Investing. I'll be talking about a new Common Sense Investing topic every 2 weeks, so subscribe. Click the bell for updates.